Sandra Koschel, your business tour guide. In our last episode, we discussed the importance of having the right business vehicle to run your business in. Today, we're going to be exploring some of those vehicles and run through the advantages and disadvantages of them. But first, let's recap what the main business vehicles are. Sole trader, partnership, company, discretionary trust, and unit trust. So let's start with the sole trader. So that means it's you personally out there in business, it's your existing tax file number, it's your ABN. From an asset protection point of view, they're really not that flash because there's no separation between your personal assets from your business assets. So if something goes wrong in the business, someone sues you, creditors attack the business, or you have to declare bankruptcy at some point, your personal assets are just mixed in there with all your business assets, so that's not really very good from an asset protection point of view. Now, there's not much scope to save tax really with a sole trader either. Any business profit really just gets lumped into your tax return along with any other income that you may have, like salary and wages, and it's just taxed at whatever tax bracket that you happen to sit in. Sole traders are, of course, the simplest business vehicle to use. So next we'll look at a partnership. Now, as the name describes, that means there's more than one person involved. Now, there's a concept involved with partnerships which is really important, and that's called joint and several liability. So what that means is you're running your business partner can go out and rack up a huge amount of business debts, and the kicker is you're responsible for those debts. And not just half of them if it's a 50-50 partnership, you're responsible for all of those debts. So that joint and several liability really is important, and it's one of the main disadvantages of having a partnership. Now, a partnership is not taxed itself. It needs a tax file number and has to lodge a tax return, but the business profit is split according to the ownership percentage. It doesn't have to be 50-50, and each of the partners pick up their share and deal with their tax separately from one another. Now, it's important to note that a partnership doesn't have to be of two individuals. You can, in fact, have a partnership of some of these other entities that we're going to cover, like a partnership of trusts is a common structure that we use. The other thing that's really important is, with any partnership, we highly recommend that a partnership agreement is drafted, preferably by a solicitor. And this will cover things like the partner's roles, what happens in the event of death, permanent disability, if someone wants to retire, how is the business going to be valued? And all of these decisions really should be discussed amongst the partners and documented up front, because everyone is happy at the start of a business, but the amount of times we see businesses get into disputes and things like that is quite high. So you really want to cover all of those things up front at the start. The only last thing with a partnership is that whenever a partner exits or a new one comes in, that's a brand new partnership. So administratively, that's a real pain. You need a new ABN, tax file number, bank account, the whole lot. So you need to think about that. If you're going to have a business where people are going to come in and the ownership percentages are going to change, then a partnership is probably not the best vehicle for you. So that's what we're going to cover today. Join me in our next episode where we'll be covering off companies, discretionary trusts, and unit trusts. Until then, enjoy your business travels.